Another edition of performance management. In today's class, we shall look at the previous lecture, the previous class, what we did in our previous class, which is transfer pricing, and we need to correct some little errors, right, committed. Now, let me quickly take us back to the question, right? I believe that some of you would have checked, watched, and jot down some important points from there, but then you just have to change some things. Now, let me quickly take you back to the question, right? Let me quickly take you back to the question. The B part of the question says that head office is considering changing the transfer pricing policy. Is considering changing the transfer pricing policy, right, to ensure maximization of company profits without demotivating either of the division and managers. Lagos division will be given autonomy to buy from external suppliers, and Abeokuta division to supply externally customers in priority to suppliers to Lagos division. Right? Don't forget that what we did is Abeokuta division. Abeokuta is the selling division. It's not also there is now an autonomy for Lagos to purchase outside. Is that also now? The question now says calculate the maximum profit that could be earned by this. Now, don't forget there is a special. There is although in this part where we have although the new manager of the Lagos division believe he can obtain fittings of the same quality and appearance for 65, so he can go outside and purchase the old 65 now, 65 naira. But the question now is, now since there is an autonomy, the maximum production that Abeokuta must produce is 200 units. Whether they sell it or they didn't sell it, they must produce 200 units. Now, out of these 200 units, they will sell 180 externally. Now, which means that what will happen to the 20,000 units? It will be of waste, right? With that, in order to encourage the divisional manager, now what they will now do is that since internal is demanding for 80 units, right? Since internal we go outside and purchase 80 units. Now, this is what they will now do. They will now say, okay, if that will be the case, since the selling division unit will remain 20,000 units, now the buying division, which is Lagos, that is being given the autonomy to buy outside, you will not purchase the whole 80,000 units. No, you will not buy the whole 80,000 units. Go outside and buy 60,000 units so that the remaining 20,000 units will now be transferred internally. Class, am I communicating? Now, that is the only error we actually committed in our previous lecture. We did not consider the 20,000 units, right? Which is very wrong, right? Now, if there is an autonomy, maximum production that Abeokuta division must produce is 200 units. Everybody have the liberty to sell outside. So Abeokuta sell outside at 180,000 units. Now, Lagos need 80,000. Lagos can go outside and buy the 80,000. All right, but there is a remainder of 20,000 units from Abeokuta. Now, in order to motivate the divisional manager, you will not go. The Lagos division will not buy everything outside. Lagos division will only purchase 60,000 units from the external suppliers. All right, the remaining 20,000 units to complete 80,000 units will be purchased internally. So that is why you will have internal transfer. So in this case, we still have an internal transfer. So we need to adjust for it. So as am I communicating?
Yes, sir. Yes, sir.
Okay, that's fine. Except those who are not in my class, in the previous class, lecture, and also did not even bother to watch the pre-recorded video, right? The class, right? So, if that will be the case, right? Let me quickly explain this again. We actually committed one error, right? Right? Which is nobody is perfect, right? It is normal. Now, the error is that we only say, oh, since we now assume that the 180,000 naira that external is demanding, we just give it without without looking at the maximum production, right? Now, we need to change it because there is an autonomy to motivate the divisional manager. If you decide that they have the capacity to produce 200 units, you now say you want to produce 180 units. Who does that? That is you must the maximum production. You must produce 200 units, right? You must do what? You must produce 200 units. And guess what will happen? They now give an autonomy, which means that the selling division can sell out externally. Now the selling division now we sell at what? We sell 180,000 units, remaining 20,000 units. What will happen to the 20,000 units? What will happen to it? If you didn't sell it, what will happen? Are you motivating the divisional manager? No. Because the question says that in order to motivate the divisional manager, they were given the autonomy to do what? To purchase outside. Right? So in this case, in our table, we need to adjust for that. Right? On this note, we need to go back and adjust. So therefore, the B part of this question will be adjusted, right? Will be adjusted from this part. Then we have internal transfer, internal sales. It will be at variable costs, right? So what is the variable cost? What is all the variable cost for the selling division? What is the variable cost? The variable cost is what are the variable costs? Okay, we sell at 75,000 75 naira per unit. Class, are we still together?
Yes.
Yes, sir.
75 naira per unit. 75 naira per unit times the 20,000 units. So what do we have here? When you multiply, what do you have?
140,000.
140,000.
That's 150,000.
150
150,000.
150,000.
Okay,
So
Sorry,
now
1
sorry,
million
75. Sorry.
500.
I'm
1
coming. I'm
million
coming.
500.
I'm coming. I'm coming. I'm coming. I'm coming. Let's quickly go back now. So now, hello, please mute your mic. Who is that? The person should mute his or her mic. Now, when in this case now, since there is an autonomy, class, listen oh, since there is an autonomy to purchase outside, Lagos division, Abeokuta division will not sell at that 75,000 75 naira per unit. Class, if please listen to this part, it's very important, right? It's very important. If Abeokuta want to sell now, since there is an autonomy, Abeokuta will not sell at 75 naira per unit stated given to us. Why? Because if the external is offering 65 naira per unit, why will you sell at 75 naira per unit? So it's like the selling division is like at the mercy of the buying division because you don't have choice because there is an autonomy. You don't have choice, right? You don't have choice. Since you sell of your 200 units, you sold 180 units to external, right? 180 units. The remaining 20,000 units will be sold based on the external supplier price, which is 65 naira per unit. You don't have choice. right? Because there is an autonomy, right? Now, let me repeat that again. They have 200 units, right? The selling division has 200 units, right? And there is an autonomy that just give aside. And you give external demand 180. Now, the remaining 20,000 units, what will happen to it? Now, the Lagos division, we want to buy the 80,000 units outside. But because in order to motivate the divisional manager, the Lagos division will not buy all the 80,000. We decide to buy 60,000 units so that the remaining 20,000 units that was not sold by Abeokuta division, so it can use it, right, as a source of revenue. So in this case now, Abeokuta division will never sell at the price of 75 naira per unit, while it will only sell at 65 naira per unit of the external the external supply. That is the price at which the external supply is willing to supply the internal division, the buying division. That is the what? That is the price at which Abeokuta division we do what? We sell in order to meet up with the 200,000 units. I hope I've been able to communicate that, class. Have I been able to explain that?
Yes,
So
sir.
now, if that is established, let's go back and adjust what we have here, right? Let's quickly go back and adjust it. So in this case, excuse me. So we can have 65. When you multiply 65 times this, what do you have?
1,300,000.
1,300,000. I hope someone will not come and ask me that how did we get to 20,000 units? Okay, let me show it. Maximum capacity. Let me just copy this. Let me copy all this. Maximum capacity. Maximum capacity 200. There is an autonomy. External demand. External demand 180. The remaining 20 will be sold internally. So this will be internal transfer. Please, the person should mute his or her mic, please. If you are not talking, mute your mic, please. Internal transfer, right? This is the 20,000 unit. This is how I arrive at the 20,000 units, right? So in this case, it will be as this. Now, so this will not affect the group, right? So what is the addition of this altogether? This will be 15 point what?
That's 15,700,000.
15.7, right? 15.7. So let's quickly, so that you will not forget. That is the first thing you need to bring in. Internal transfer, right? It will be a cost to Lagos division 1.3, 1.3, right? 1.3, 1.3. Okay. So external supply. You know now, the Lagos division, the external supply will not be, it will not be 80 again anymore, right? It will be 60. Why? Because internal, Abeokuta will supply 20, while Lagos, okay, this will also change, right? Okay, to not change it. Okay, so this will be 60, right? This will be what? 60. Do you know why? Because 20,000 will be purchased internally, Why 60,000 units will be purchased from the external suppliers, right? So when you multiply, what do you have? 60 times,
3.9 million.
what do you say?
3.9 million.
3.9 million. So this will be 3.9 million. If you have question, I have to finish this first. 3.9 million, right? Now, if that is established, that is what 3.9 million. Where do we have again? Okay, material of 80. So now in this case now, in the case of material here, it will be 200 units because what you will use to produce the maximum, you have the maximum capacity to produce 200 units. So of course, when you want to produce the 200 units, you will definitely use material, right? So this will be 200 units. So 200 times 200 unit times 5, what do you have?
Is 1 million naira.
So this is 1 million. This is 1 million, right? Of course, this they will need material to convert it to inverter. So that is 80,000 units. So when you add these two together, you will have this is 17 million, right? This is 17 million, right? So Abeokuta 2, it will be 200 units as well. 200 units. So 200 units times 500, what do you have? 200 units times 500, what do you have?
3 million.
This is 3 million. 3 million. Okay. So this will change to 6.6 million. 6.6 million. So in this case, what is the group profit? What is the profit? Uh, Definitely all these things will change. What is the profit? Tolulokwe? Tolulokwe?
Okay, I'm sorry, sir. Mistake, sorry.
Okay. Okay, so please give me a figure. Total sales minus the cost. What do you have here?
That should be 7,300,000.
Okay, this is 7,300,000. Now, check this. I think this should be the same, but check, confirmed. 36, when you minus it, what do you have again
The
from this
group
part?
profits. The group
Okay,
profits.
okay.
14,300,000.
Is it 14 million?
As in for the group, oh, the
Yes,
last part.
yes.
14,300,000.
14,300,000. Can someone confirm that again? What about the Lagos? What about Lagos? What about Lagos?
That's 3,760,000.
760. Okay, it is 3,760,000, right?
Yes, sir.
Okay. Please confirm this figure again. Confirm these figures again. This is 3.9. This is 17. This is 6,600,000. You remove it. Why you remove 11,840. Please confirm. Okay. Hello, are you still there? Hello?
11 million sixty
Yes, sir.
thousand.
11 million?
60,000.
60,000 for the group.
Uh-huh. 11,060,000. Adekoya, are you still there?
Yes, sir. I'm still here.
That's fine. So, can you see it now? That is, we are not supposed to have we are not supposed to have the same profit, because if we are having the same group profit, we will not be able to recommend. Class, I hope you are with your pen. Don't forget, my own, I don't know. I usually, even in professional level, I usually say it that when you are in my class, right, you have to pay attention. I will make you to pay attention, right? That's in the sense that I will not write anything. Now, you know, let's just look at it. You need to understand, right? Now, the C part of this question says that what is the C part? Someone should read the C part. Do you have the question? No. Okay. No. Okay. Discuss the issues of encouraging divisional manager to take decisions in interest of the company as a whole, where transfer pricing is used, right? We should do what? We should discuss, we should do what? We should discuss the issue in what? The issue in what? In transfer pricing. Now, one thing about transfer pricing is that if you are given autonomy, you may take it for granted, right? If you want to encourage the divisional managers, some divisional managers may actually what? Take that decision for granted. Now, let me quickly come back to recommendations. What you will recommend is that Abimbola PLC, the company policy should ensure that Abimbola division is prepared to sell set of fittings to Lagos at a price of 65 naira per set. The Abeokuta division manager should agree to this, as it is what? In best interest, right? As it is what? The best interest. Now, do you know why? Because the best interest is for the purpose of go congress, the maximization of profits of the organization, right? Now, when you look at it, when the transfer pricing is being set at 75 naira per unit, there is no autonomy. The group profit is 10,160,000. But when there is an autonomy, the group profit increases to 11,060,000. So this is to tell you that the Abimbola enterprise should allow Abeokuta PLC to sell the price of what? 65 naira per unit, right? Because, excuse me, because it will do what? It will maximize the profits of the organization. In order to maximize the profit of the organization, it is advisable. It is advisable for Abimbola Enterprise to allow Abeokuta PLC, Abeokuta Division, to sell at a price of 65 naira per unit, in order to what? In order to maximize the group profit. Class, are we still together?
Yes, sir.
Yes,
It's
sir.
Please, do we get that? Excuse me. If you don't understand, let me know. Unless if you are not, unless if you are not in our class in the previous class. You were not in class when we treat transfer pricing, and you fail to go back to it. Like you refuse to go back to the video to watch the video. Any question? Okay. So this question is one of the Ican question as well as ACCA transfer pricing. Now to the business of the day. Transfer pricing with opportunity cost. What is the principle? The principle is that you will transfer at variable cost plus the contribution lost. Is that not so? That is the principle. Because let me quickly use a simple, let me quickly make an illustration so that when we read the question, you can be able to, you can pick from there, you pick it up from there, right? You have the capacity to produce 50,000 units. External is demanding for 40,000 units. Internal is demanding for 20,000 units. 50,000. External is demanding for 40. Internal is demanding for 20. You can see that the capacity is not enough. Then the question now says that the transfer price is based on opportunity cost, right? Then you read the required. Now, if the transfer price is based on opportunity cost, the required could be that the selling division must sell to internal first. If external will give me a larger profit and I must sell to internal first, the transfer price is based on opportunity cost. I must sell to internal first. In this case, I don't have a choice other than to say, okay, since I have capacity to produce 50,000 units, I will give internal 20,000 units. I have what? 30,000 units. And external is demanding for 40,000 units. The remaining 10,000 units that I lost as a result of satisfying the internal, it is an opportunity cost. So therefore, the transfer price will be based on the marginal cost of producing the whole unit plus the amount that I lost instead of the loss I've forgone, right? For me to transfer to internal. And that is the principle I want you all to get to understand, right? Now, required as usual, assuming that division AC buys all the components, it requires from division C produce a profit statement for each division detailing sales and cost, showing the external sales and internal company transfer separately where appropriate. 8 marks. Now, they say assuming division C buys all, probably division C is the buying division, buys all from division IC. We should now do what? The profit statement. And we don't know the policy. We will get there. B, a specialist external supplier has approached, right? Has approached division AC, which is like a buying division, and offer to supply 80,000 components at a price of 8,400 each. The components fulfill the same function as those manufactured by division IC. The manager of division AC has accepted the offer, has agreed to buy all the components it requires from its suppliers. Produce a revised profit statement. What it means is that there is also an autonomy here. They decide to go and purchase from the external suppliers the 80,000 components, right? 8 marks. Division IC. Wow. Division IC has just received an inquiry from new customer for the production of 25,000 components. The manager of division IC requires a total profit of 90 million for the year for the division. Calculate the minimum price per component to sell the 25,000 components to the new customer. That could enable the manager of division IC to meet the profit target. Note, this order will have no effect on divisional fixed costs and no impact on the 150 component division IC sales to its external customers at 10,000 naira per component. Division AC will continue to purchase 80,000 components it requires from the specialist external supplier, which is 8 marks. Discuss the potential implication of TLC of outsourcing the production of one type of component that it manufactures. 4 marks. Explain to TLC what triple bottom line reporting means. 2 marks. The total marks allotted is 30 marks. So this is one of the compulsory questions, right? Interesting. Now, let's quickly go back to the question. Let's start from the question. Please pay attention for those who are in this class, right? Okay, 18, that's fine. TLC Limited is a high-tech company. Don't forget, what are the things you need to look for in transfer pricing? See, who is the selling division? Who is the buying division? What is the transfer pricing policy? Then, the required. What did they say you should do? Once you understand this, you don't have any issue. You will not have any problem in transfer pricing because it's very simple like that. Now, where are we? Okay. Now, it started operations 5 years ago in Abuja. It has 2 major divisions, division IC and division AC. IC division manufactures components for television. It sells component to division AC. Now, this is to tell you that division IC is the selling division. It sells component to division AC and to external customers. So, which means that division IC we manufacture the components for television, we sell to the division, which is AFC, and we still sell to the external customers. That is 2, right? That is 2. Division AC uses 5 of the components in each of the televisions that it manufactures and sells television directly to external customers. Class, Division AC, we buy a component, 5 components from division IC. Division AC is the selling division. Division AC, we now buy 5 of the components. That 5 of the components will be used in manufactures and sales of television to process it, right? Then division AC now, in the table given in the table, this is variable cost, right? The following information relating to next year is also available. We have the fixed cost of the selling division. The capacity is 175 capacity, 175,000 components. Don't forget, division AC needs 5 components to process its own television. External demand, out of 175 capacity, the demand for external is 150. What will now remain? For demand from AC is 80,000 components. Anticipated external market price, which means that the selling division we sell outside at we sell outside at 10,000 naira per component when you want to sell outside. While division AC, which is the buying division, we have the sales price. Division AC, we buy from internal and sell outside at 90,000 naira per component, because sales price means selling price, sales price class means selling price. The direct material per component per television, before they can be able to process this television, division AC, we need 5 components to process this television. Don't forget. The direct material, the direct labor, and the variable overhead. In addition to the variable cost above, each television produced needs 5 components, which means that the same 5 components that division AC needs from division IC. Don't forget, division AC uses 5 components in each of the television, right? Now, for division AC to process the television, needs 5 components. Fixed cost, can you see it? It needs 5 components. So how many components or how many units did division AC now need? You can see that this question is tricky. They're supposed to give us, but they say it is 5 components. How do we arrive at that? Fixed costs are budgeted to be this for each year. Annual sales of television are expected to be 16,000 units. Class, division AC, we required 5 components to process television, and they are expected to have a sales of 16,000 units. So definitely, if you want to make a sales of 16,000 units, how many components will you use to make a sales of 16,000 units? Therefore, the component will be 5 times 16,000. 5 times 16,000 will give us how many components, class? Will give us how many components, class?
That's 80,000.
80,000 components. Can you see it? Now, if you don't know, you will use 16,000 units and say that is the annual sales and you move on. Don't forget. See, always understand it. The key, the I can actually, they actually padlock, but if you check the performance, very low. I think the performance was very low thereabouts. It is components that they will use to produce television. It is 5 components. Okay, thank you. Thank you. It is 5 components. Now, and they have to sell 16,000 units. Now, if they want to produce 16,000 units, they have to use 5 components for 1 unit. So what is the total component? That is 80,000 components. And that is the maximum production of AC, because AC is the what? Is the buying division. IC is the selling division. Class, are we still together? You can see that transfer pricing is interesting. If you understand the logic, it's for you. You understand it. If you understand the logic. Class, are we still together? Hello? Okay.
Yes, sir.
It seems you are the only one in this class. Others, I don't know what. Okay. Here is Pere. And
Yes, sir.
okay. That's fine. That's fine. Okay. Transfer pricing policy. What is the policy? Transfer prices are set at opportunity cost. At what? At opportunity cost. Take note. Now, if the transfer price is set at opportunity cost, what happens again? Division IC must satisfy the demand of division AC before selling components, and the transfer pricing policy is based on opportunity costs. It must sell to AC first. Now, division AC now still is allowed, is also allowed to purchase components from division IC or from external supply, which means this is one. There is an autonomy again, right? But we already know that the transfer price policy, if you want to transfer it to buying division, it will be based on opportunity cost. Then what is opportunity cost? The marginal cost, the selling division, which is the variable cost, what the selling division used to produce that product, that component, plus what the selling division forgone to satisfy the internal division will be the selling price, will be the what? The transfer price. Right? A. Assuming that division AC buys all the components, which means that they need to first of all sell all the components to the buying division, produce a profit statement. They need to sell all the components first. They satisfy the buying division first. So once it's satisfied, you can now. So when you are transferring it, it is based on opportunity cost. Produce a report, a profit statement for each division, detailing the sales and cost, 8 marks. Class, very simple. Very, very what? Very simple and straightforward. Are we still together? Suggested solution.
Yes.
Suggested solution. Okay. Now, where do we start from? Let's start from our usual workings. Let me just copy what is here. Tolulope, when it is 5 minutes to end the meeting, just let me know so I can create another link. Thank you. So the name of the company, we need to change the name of the company. It doesn't matter what comes first, whether the selling division or the buying division. TLC Limited. TLC Limited. TLC Limited. So which one of these are we using? The selling, assuming that division A buys all the components it requires from IC. So IC is the selling division. Division IC. Division IC. Division AC, right? Division AC. Okay. So we need to arrange it internal. Let's start from internal transfer or internal sales. Let's say work 1. Please pay attention to this part. If you understand it, you understand it all. Right? Workings. Right? Workings. Don't forget it is based on opportunity cost. I have to approach, and that is why we are next gen professional associates. I have to approach to solve this question. Whichever approach you feel is convenient for you, then you are free to choose any of the two methods. Any of the two methods, right? Okay. Okay. Maximum capacity. Division IC, which is the selling division. What is the component? What is the maximum capacity of the component? Please, you can screenshot this. Production capacity.
175,000.
175,000. Good. 175,000 components. 175,000 components. Now, they need to sell. That is what the policy says. That is what the A part of this question says, that assuming that division AC buys all the components it requires from IC. So therefore, the transfer price will be based on what opportunity cost, because the policy is that transfer prices are set at opportunity cost, right? Are set at what? At opportunity. So they need to sell to internal first, right? Assuming they buy all from division IC, right? Now, internal demand, right? So internal demand, don't forget, they need 5 components. each 5 components. Let me use this way. Components per unit. How many units? 16,000 units. Okay. 16,000 units. So let me show you 5 components per unit. 5 components per unit. Class, are we still together? We need 5 components and they will sell this. For them to sell this, for them to convert it to 16,000 units, they will need 5 components. One component for 16,000 units, then they need 5 components. If one unit is 5 components, so they need 16,000 units, right? So what is the total components? Tolu, where is that?
So it's already 5 minutes. 4 minutes now.
Okay. 80,000 components. Okay. That's fine. You will see by at the end of this class, you will appreciate transfer pricing, right? You appreciate this topic that it is very simple. It's just for you to get the right person to teach you, right? Transfer pricing. Even performance management generally is nothing. Just understand principle. I always believe in principle. Understand each of the topic. Go and check what is even the principle that guides this topic that make it look difficult, right? So let me quickly create another link so that we can continue. Remember, we must complete this question, right? Once we complete this question, then we move on Friday, we'll do another question. On Sunday, we'll do another question. I mean, that is how many questions is that? Sunday 1, Tuesday 1, Friday 1, Sunday 1. That is 4. So we'll now solve another question. That is, we'll solve like 5 questions. Then the ball is in your court. Go and look for more transfer pricing question, right? Then we will now we'll move to budget. We'll move to what? Budget. Thank you. Let me quickly create another link so that we can continue our lecture. Thank you.